Thank you for joining this Fifth Era webinar. As I'm speaking, France is kicking off with Spain. So it's great to see so many of you are prioritizing your education and learning over your entertainment. But anyhow, um, today we're going to be talking about investing in innovation. This is a webinar that we've done a number of times in the past, updated, of course. And it's really intended for investors who want to understand the thought process that venture capitalists and people like us go through as we think about our investment thesis, our investment strategy, and the specific actions we take as innovation-based investors. And I'll cover all of those points in the course of this. I have to show you this page. We are an RIA, we're regulated. There will be no specific investment advice presented. This is educational only, and you should make your own investment decisions, not relying upon this content. Who are we? We are a specialized asset manager. We focus on exponential technologies. We have a very clear investment thesis, which I'm going to share with you a little bit later as an illustration. And we are SEC registered, FCA appointed in the UK, and we're registered in Switzerland at the fund level. We've been doing this for a long time, 13 years as Fifth Era, but for a couple of decades prior to that too. And on the lower level, we're very happy with progress to date. We have a very diversified portfolio, including more than 80 unicorns that we have exposure to. Here's those unicorns, because we did put a lot of energy in the last 10 years into blockchain. Many of these, in fact, the majority of them by far are blockchain related. But as I'll talk about later, our investment thesis also today includes AI, internet, and blockchain. And this page I will not present until later because this is essentially our investment strategy. And I want to give it as an illustration of how you might think about building your investment strategy. So these are the key 9 points we'll cover off. Most of them we'll do with one page. The first couple we'll spend longer over. And this is really a frame of reference for anyone who's thinking about essentially becoming a venture capital investor of one sort or another, a GP, an LP, an angel investor. I think there are some very common points across all of those different ways to play. The first is you need to have a very clear, in your own mind, perspective on what the future is going to look like, how it's going to change what we do today, and why value is going to be untapped, and why tailwinds are going to drive us towards the future that you think is inevitable. And I'll talk about that in point one. Then you need a very clear investment thesis. It helps you not only define the types of investments you'll make, but it also helps you decide what you should not be investing in. Thirdly, you need a clear and advantage strategy, and I'll share ours when we get there. But there's literally thousands and thousands of venture firms, as an example, here in Silicon Valley, and most of them do not have advantage strategies. So you need to try and figure out how you're going to have one, how you're going to have an edge. And then all the other points are one page each. You need to stick to some core best practices. You need to try and get access to the best investors and know them and hopefully invest with them. You need to be highly diversified. You need to follow on selectively when emerging category leaders are beginning to appear. And then the last 2 points are very true, but they're minor points. Invest through the downturns and be patient. So first of all, this vision of the future is something that you may or may not have. And obviously people can differ in their views. And by the time you get down to investing, you can't invest in everything. For Alice and I, when we launched Fifth Era, we'd already spent 20 years trying to develop our future vision. We've written books about it. You can find them on Amazon and Apple and ACX and other places. But just to crystallize it, we think the world is moving out of the industrial era into a new era that we call the Fifth Era. And it's an era which is fundamentally different from anything we've known before. A lot of the assumptions of the industrial era no longer apply. Things like economies of scale and scope are getting broken as we speak. So three major innovations: digitalization of everything, the life sciences revolution and not only the reinvention of plants and animals and food, but potentially humans and medicines ourselves. And then, of course, moving out of a carbon economy and creating energy in new and different ways. There are a lot of other innovations that play as well, but these are, in our minds, are the big three, and we're 100% focused on the first. We focus on digital exponential technologies, and I'll talk more about that through the rest of this. But that doesn't mean that you, as an investor, couldn't choose to be life sciences only or clean energy only. That's for your choice. Ours happens to have been digitalization. But the more important point is you need to then start thinking about what's going to change. And that you can read our book and pick it up on Amazon. And we do this about 10 years old now, but it was a bestseller and it helps you think about it. And when we got started 30 years ago, the internet was central to that. And if you just look at the impact when we digitalize all the world's communications and content over the last 20 and 30 years, what we ended up with was almost all the world's most valuable companies being companies that focused on that innovation. There are a couple of exceptions like Saudi Aramco, but pretty much every other one of the most valuable companies in the world is either an internet focused company or it's a company that today has transformed itself. And in fact, there's no company on this list that doesn't rely upon innovation based technologies, internet based technologies for everything they do. Um, we don't think that process is finished. In fact, we think it's just beginning. So, on the left hand side, we've sort of moved through three big waves: the initial digitization of communications and content, and the standing up of electronic commerce version one. Then we did about 10 years of platformization where we created much more complex offerings like Uber, Airbnb, and so on. And then I think we've gone quite quickly through a phase of full stack integration where companies such as Tesla, being a good example, have tried to figure out how do we bring a bunch of different things together: software, hardware, AI, energy, etc. And we're seeing that in the fintech space where, Alipay and WePay are really super apps at this point. But on the right hand side, we think we're now moving into a much more powerful wave. We think that we have yet to digitalize identity and provenance and trust and the movement of value over the internet. And we think software is going to eat much more of the world than it's eaten to date. And we're going to end up with something called an autonomous digital economy, which is it's sitting at the convergence of internet, blockchain, and AI. And we have other webinars that you can listen to that take you through all of this. But this is actually the most important part of our investment thesis. We believe that we're heading into a world where builders who build leveraging internet, AI, and blockchain are going to be able to create companies and businesses that will absolutely destroy existing legacy businesses and industries. So this is at the heart of what we invest in, and we think it's already happening. So all of this is our future view, and you need a future view too. So your future view can be quite different from ours. I just shared as quickly as I could some elements of ours. But the reason you need that is because you're a venture capitalist and you're going to be backing builders and their companies building towards a future. And if they're building in a direction that is inconsistent with the vision that you have of the future, maybe they don't fit, or maybe they're wrong, or maybe you're wrong, which is a possibility too. So a clear future view that you believe is inevitable is the starting point of being an innovation-based investor. And there's a few more words here, but we think that this is for us a powerful part. Now, the next part I'll do very quickly, but you need to then boil that down to an investment thesis, just really as a reality check to help you direct your activities, but also so you can articulate things to your LPs if you're raising capital, or other investors if you're working with them, or even founders who want to know what you do. And we updated this in 26, but this is actually built off a 15-year-old investment thesis, most of the words of which we've still not changed. For us, the investment thesis is the internet digitalized communications and content. We know it was the greatest value creation event so far. However, value and intelligence and indeed work are not yet digital. So as we digitalize those things, we progress towards an advanced digital economy. And when we digitalize commerce, we actually sort of begin to complete that journey, but that will require a bunch of stuff: the digitalization of trust through blockchain, the digitalization of intelligence and work through AI, and the arrival of autonomy, both for human beings as well as for machines, which will also mean the disintermediation of many people that we rely upon today. And all of that will lead to this autonomous digital economy I already discussed, and we think it will be the biggest value creation event to date. So that's how we articulate our investment thesis. You'll come up with your own, but the most important point is you do need it, because you can't always have 5 PowerPoint pages in every elevator that you're trying to describe what you do. Now, then you have to get down to investment strategies. And here you're looking for an edge. Simply put, you need to have an edge. We took a long time trying to figure out ours, and we do think we have an edge. But the way we go about it is we have three different strategies, investment strategies, depending upon the stage. So in the early stage, we think the only way to get an edge is to be an investor with the world's best persistent early stage investors in the spaces that you're focused on, in our case, internet, AI, and blockchain. So that's what we do. In the early stage, we have fund of funds, and the fund of funds invest in the best venture firms we can find. And we have literally hundreds of investment partners working for us, essentially. We've given them our money. They return our capital as they get distributions, but they're the ones that do the due diligence on the companies they want to invest in. So that's why we're in 80 unicorns, some direct, but many of them indirect through the fund of fund strategy. We then take all of the combined portfolio, the investments they make, the due diligence they share, where their conviction sits, and we boil that down to privileged access and asymmetrical information, and we make concentrated mid and late stage bets, very targeted on the emerging category leaders once the crowd of venture capital general partners begin to agree that X or Y or Z is probably the winner in a particular space or theme. And then our third investment strategy, which is not on this page, is we also help small numbers of companies go public. So that's why we think we have an edge. So remember, a future view, an investment thesis, and then a set of strategies. That's what we do for a living, but you're going to have to come up with your own. For us, we're a specialist. We think we have a clear framework. We certainly believe we have privileged access and asymmetrical information, which are very important in private markets. And everything we do is on an institutional platform. The next points I'm going to move through really, really fast, probably 1 to 2 pages at max for each. The first is there are some best practices of venture investing. And when Alice and I started 30 years ago being venture investors in Silicon Valley, we tried to learn everything we could. And what we realized was it didn't make sense to write books on the topic. We should instead share the wisdom of other great investors. So we wrote this book, The Intelligent Investor Silicon Valley. You can find it on Amazon and Apple. And all it is a synthesis of 60 people or so telling you what they do and why they do it and how they do it. But if you boil down everything they say, you end up with something like this. It's not very complicated, but it's very hard to make it happen. You need proprietary deal flow. You cannot be a drive-by crowd-funded investor, because you're going to get all the adverse selection and all the bad actors pitching you. So you need high-quality proprietary deal flow. Secondly, you need a strong due diligence culture. All the academic research says that if you really do good due diligence, you get a much better return. And conversely, People that don't do due diligence get adverse selection and they lose a lot of their money as a result. All venture investors lose a lot of their money, about two-thirds of their investments. But if you're a flyby investor, it can be 90+% of the deals go under. You need active participation in the portfolio companies. The best VCs and angels help their companies get to better exits and returns. And then the last couple of points, you can't do everything. You need to have deep expertise where you are focusing, and you need tight relationships with people that can make your companies succeed when you don't have the capital to get them over the final. And certainly if they're going to go public, obviously a lot of capital is required in the late stages, and you don't want to be washed away by follow-on investors that dilute you to nothing. So therefore, you need to know really good funds and GPs. And we've put an enormous amount of energy getting to know, as I said, 50 or 60 venture managers and the hundreds of investment professionals that work for them. All of the analysis, and this is from both McKinsey and private markets, demonstrates that venture is a very high returning expected return asset class, but it's highly skewed. The top quartile get exceptional results. This is overall, but when you double click on this and you look at early v mid v late stage venture capital, it's the early stage guys that get enormous superior returns if they're in the top quartile. But on average, it's a very different story. The good news is there's high persistency in the top quartile. So University of Chicago has done a lot of research on this. Second bullet point, top quartile about 45% persistency, top half about 71% persistency. So you can't guarantee that if you are in a top quartile fund that they will continue to be top quartile, but you have a higher expected persistency rate than almost any other asset class. So the big challenge then becomes access. Can you actually get the very best VCs to take your capital? And that is very hard. We do it through relationship and value added, but it's not easy. And these are some of our fund managers. I won't go through them in detail. You also, because of the very unique nature of venture capital, have to be diversified in the early stages. And this is also a very long conversation, but I'll try and boil it down to a single chart or two. Public markets are normal distributions. Conventional wisdom says they're efficient markets. So theoretically, you shouldn't be able to get a superior return at all. And at the same time, you can make a set of investments into the public markets and hope to get roughly the expected return of the asset class. Private markets, and particularly venture capital, are completely different. They are power law or power curve distributions, which means on the right-hand side, most investments you make are going to fail. Even for the world's best venture capitalists, they average about two-thirds failure, 1x and lower. About a third of their investments are getting something between a 1 and a 5x, which is okay. It can return the portfolio, but it's not superior returns. It's the 10% of their investments that are 5x and better that get them the superior returns. And in fact, for the very top venture capitalists, if they make 30 investments, it's 3 to 5 of those investments that will return almost all of the capital that gives them their return. So this is a hit-driven business, and diversification is required because just probabilistically, you could make 30 investments and all of them might fail. So diversification really matters. You also want to follow on invest, but only when the very best investors are all agreeing that the category leader is becoming visible. And this is why we take this population very seriously. It's not so much that one venture capitalist says, I've got really high conviction this company is going public, because they'll say that for every company that they back. What you're actually looking for is 5 and 6 and 7 venture capitalists to all agree that the emerging winner in a particular sector is this company, and they're following on with additional capital, and new investors are joining the company and the cap table. So this is more a broad conviction of the industry that this is the emerging category leader and that it's going to be a mega acquisition or indeed a public company. And so that's when you follow on. You follow on when there's a high conviction. You do not follow on in general. So there's actually academic evidence that says if you're one and done in the early stage, you actually get a better return than if you consistently follow on as companies ask you for more money. Because within the ones that you give more money to in the mid stage are both the winners and the losers, and there's more losers than winners. So I could go into that in more detail, but hopefully you get the point on that one. And the last 2 points, just to finish up, by now there is 75 years of evidence that returns go up as recessions and downturns occur. And it's sort of counterintuitive to many investors. Most investors allocate more capital when times are good, and they get frozen and they don't invest capital when times are bad. But all the evidence says that that is exactly the wrong behavior. You should invest less when markets are hot, and you should invest more when we're in the middle of a recession and a downturn. And the funds that get launched in downturns outperform, at least in venture capital, the funds that get launched in good times. And the reasons are pretty obvious. They get low valuations on the investments they make. They have less competition because the funding environment has contracted and the companies have less leverage when they set their valuations. And the companies that do get funded have less competition as they ramp up their businesses. And then there's a couple of other benefits as well. So I think Warren Buffett says this one best. The way he says it is if you loved socks and socks were on sale, would you buy more socks or less socks? And the answer, of course, is you'd buy more socks. And of course, the funny part of that is, of course, he just lost the T because the same is true of stocks. You should buy stocks when they're cheap, not when they're expensive. And yet, almost every investor does the reverse. So, at minimum, you should dollar cost average, which is to say, if you like a venture capitalist and if they're doing well, you should be in their fund one, fund two, fund three. You don't want to just be in their fund one, not only because of these dynamics, but also because innovation never stops. There's always a new innovation around the corner. And the last thing is patience. And here, everything I've described is investing in innovation. By definition, it's long-term illiquid investing, and you have to be patient. I chose this chart because Cambridge Associates recently created a very interesting report where they looked at one of the spaces we invest in, blockchain venture. And for the longest time, through up and down cycles, people have been saying, is blockchain venture capital a good thing to invest in? And they finally came back and said, yes, it absolutely is. So what's on this chart is from Cambridge Associates. All venture capital they track, excluding blockchain venture capital, median 14.1%, top quartile 16.4. Now remember, this combines early, mid, and late stage. If you unbundled those, early stages higher, late stages lower. And then look at the blockchain funds, 21% medium, 25.8% top quartile. Blockchain capital significantly outperforms all venture capital, excluding blockchain venture capital, but you would have had to wait 10 years to get that answer. And in innovation, that's one of your challenges. To catch an innovation wave, you sort of want to be early, but it's going to take you 10 years to figure out whether you got it right. So that summarizes everything. Investing in innovation is not for the faint-hearted. If you really want to do it, you need to put in your time. And these 9 things are things you should know about and figure out for yourselves. There's many ways to play. If you were to look at that earlier book, Build Your Fortune in the Fifth Era, Alice and I actually went over the different ways to play, be a GP, be an LP, be an angel, be an employee, be a founder, etc., and some of the ways in which you might decide what's right for you. I don't think innovation investing is right for everyone, but I certainly think almost every investor in the world is underallocated and they have too much of their money in public equities and fixed income and not enough in the sectors and the innovations that are driving the future and capturing all of the value. So, closing thoughts, for what we do, we think we've seen it before. Most of the alpha of the public markets has been driven by software and the internet over the last 20 years. We think we're going now into a new phase, the autonomous digital economy, where blockchain, AI, and agents are coming together and converging. And we think that the fifth era is going to be driven by this, and that the value is going to be captured by the builders that understand what's on this sheet of paper and who are being backed by investors that are willing to back them. And if you want to learn more about what we do, please just ping us ir@fifthera.com or go to fifthera.com if you want more content. Thank you so much for joining us. Really appreciate it. It's probably not too late to watch the rest of France v Spain, and good luck, England. Thank you very much.